Question I have is regarding the ballooning balance sheet of the Fed. They have about $2 trillion more, as you mentioned, and also being very upfront about where policy is going now. My concern is I've never heard anything about the exit strategy that the Fed has with that. Is that the new balance sheet norm? Do you plan on going back down to $1 trillion? And then the question is, if you guys say we're planning on doing this at this rate, market participants are smart. They know that supply is going to exceed demand, interest rates are going to go up, and the Fed potentially is going to be looking at a loss on $2 trillion of long-term bonds. So my question is, with that, I don't understand the workings of it. Who pays for that loss? Is that just simply a Fed, print money, or does that go to the taxpayers, or what happens with that?
So these are great questions. So let me start by talking about, we described our exit strategy in a statement that we released in June of 2011. And the basic timing is going to be that we're going to go through a process called reserve draining. And without getting, that's essentially a way to offer the banks a way to park the reserves that they're holding so that there's no way that those can get into the system. Essentially, we're going to be offering the equivalent of CDs for the banks that are holding deposits with us. Their reserves are really like the deposits they hold with the Fed. And that'll be the first step. That's a technical step which is designed to ensure that the second step will actually have the impact we want in the economy, which is the next step will be to raise the interest rate on excess reserves. So what does that mean, that we're raising the interest rate on excess reserves? Well, the reason we'd be raising rates is because we're worried about, at that stage, we're not worried about it now, but at that stage we'd be worried about undue demand forces pushing upward on prices to an undue extent. And we'd be trying to tamp down those forces. By offering a higher interest rate on excess reserves, we're going to be deterring banks from making the loans that will actually stimulate those higher inflationary pressures. So this really allows the Fed a tremendous amount of flexibility to be able to control inflationary pressures with a very large balance sheet. And I think this is, one of my colleagues, John Williams, gave a great speech about this a couple of years ago. The Fed was given a new tool by Congress in 2008. It had been planned to be given that long before that, but it turned out in 2008, that's when it was implemented, was to pay this interest on reserves. Before that, the size of the balance sheet really played a very tight role in thinking about, I think, what inflationary pressures are. Now, because you're able to pay interest on those balances that the banks are holding with the Fed, that connection has really been broken. So you asked the second question, which I think is an important one to think about, is what's going to happen to the losses? Well, the Fed isn't, it's not a profit-making institution, so it's not that you don't want to be thinking about it in the same way as you would for a typical bank. We're a policy-making institution, making policy for the American people. With that said, right, you might have read last week that we paid to the Treasury a large amount of money last year. So the current estimate is something on the order of $90 billion. Where did that money come from? It came from the fact that we're paying very low interest on the deposits the banks are holding with us, on our reserves, and we're getting relatively large payments from our longer-term assets that we're holding. When we go to raise rates, we're going to have to, the amount we're going to be paying to the Treasury is going to go down. That's basically how that's going to manifest itself. This is part of the policy. This means that the Fed is exposed to the interest rate risk, and then the payments that we make to the Treasury is exposed to the interest rate risk that otherwise the private sector would be exposed to. And by taking that onto our balance sheet, we are stimulating economic activity today because the private sector hasn't got that on their balance sheet. That instead is being held by the public sector, the Federal Reserve. So that's the way it's going to work out. If you want to read more details about our exit strategy, it's on our website, June 2011. You can look at that statement. But then the mechanics of it, there's going to be a reduction in, right now, I think $90 billion will probably be close to some kind of record for what we pay the Treasury. That's going to come down in future years when we go to raise rates.
Thank you. The accommodative stance of the Fed is supposedly going to make banks, or was to make banks lend. In the real world, without a crowbar, you can't get a dime out of a bank. list your last name as Buffett. So when you say, well, we're going to raise the rates and that's going to raise the amount we pay, that's going to cause banks not to loan. They're not loaning now, and even getting a mortgage is exceedingly difficult, and now the new consumer financial protection place wants to make it even harder. So how are your policy actually going to get the institutions that you're trying to move to actually do something versus an academic thing which they're not actually following?
So these, I think that there are impediments certainly that in I think you're pointing to one concern that we have. There's certainly impediments that are making monetary policy not as effective as typically would be true. With that said, there's a number of channels through which low interest rates start to stimulate the economy. I talked about how it deters saving, encouraging spending. That's one channel through which it works. Having low interest rates pushes upward on all asset prices, including stock prices. So having higher equity values, that puts more money in people's pockets, gives them more confidence about what they're going to have in the future in terms of what they need for retirement and other needs. That's another way that it's going to stimulate spending. It also pushes downward on the value of the U.S. dollar. That's another way that's going to stimulate demand for U.S. exports. That's another way the policy works to stimulate activity. All told, I think the policy is stimulative, but as you're pointing to, I think there are definitely impediments in the wake of the financial crisis where it's not as stimulative as it would otherwise be. I don't think that means that when I think through that logic, where policy is stimulative and not as stimulative as it would otherwise be, it doesn't mean that I want to back away from stimulus. So that's the way I think, at least that I've been thinking about the considerations involved.
My question is about the recent liquidity event in downtown Minneapolis and wondering about the condition of your basement. Are there large pallets of soggy dollar bills and do you need help cleaning that up?
Well, who asked that question? So, it's always good to have volunteers, and that's the kind of Minnesota volunteerism that I know and love. But the good news is that the bank was untouched by the event. Certainly made the main consequence for us is that our water supply was shut down for some period of time because of Minneapolis needing to try to fix what was going on in terms of the water main. But yeah, no. But our thanks for the concern. But our structure, the integrity of our structure has been preserved.
Since this time last year, it seems like your position has kind of changed and maybe gotten more dovish. And would you say that that's indicative of the whole board? And when you look at who's going to be on the FOMC next year, do you see people with a similar belief as you?
You know, so I'll talk about my own views. I really can't talk about other people's views they speak for themselves, and I think in the last 2 days, I think 5 people have spoken, so you can read what they have to say for themselves, including the chairman has spoken. So I think that in terms of my own views, I've described how my outlook today shapes what I see as the appropriate monetary policy stance, and my views about inflationary pressures in the economy, I think, have gone through a change over the past year. And I think that how do those views change? I think, first of all, it's coming from the fact that inflation did not evolve over the course of 2012 as I was expecting it to. It evolved much closer to other people who had different models of the world than I did. And when I say by different models of the world, I think the key question is, what kind of wage pressure should we expect to be out there when we have unemployment of as high as we do? And I was concerned about, and I remain concerned about this possibility, that we could have more of that unemployment could be structural than we currently think it is. And with that possibility, how would that manifest itself? It would mean that pool of workers that's non-employed, unemployed, is not really putting downward pressure on wages because employers don't really want to hire them. So that would be a situation where if you had enough private demand upward pressures on private demand, that would manifest themselves more in terms of inflation, in terms of first in higher wages, then in terms of inflation, than they would in higher employment. Those are my concerns a year ago. And we've done a lot of work internal to the Federal Reserve on this question about how much is structural. And boy, I have to say, there's just been a lot of outstanding, and there's been work at academia too, but I'll toot the Fed's horn. I mean, there's been a lot of really outstanding work by staff analysts about what's going on. Really hard to make that structural case work, I would say. So that's one piece of evidence. And the other piece of evidence is just, as I described earlier, behavior inflation, behavior wages over the past year. Very hard to make that work. We have to be vigilant in this following sense. This is a story that will be evolving. This is a story that might well be changing over time. So you wanted to call me dovish or hawkish. I mean, I'm just a person who's trying to make policy so as to achieve the goals set by Congress and looking at the data to try to do the best job I can all along those dimensions. And it may come to a point where we say, boy, unemployment's 7%, and look at what's going on with wage pressures, what's going on with inflationary pressures. The beauty of the forward guidance, the threshold forward guidance that the Fed has offered, is it provides an out along those lines. That is, if we see inflation go up above, our medium-term outlook for inflation rises above 2.5%, we're forced to sit back and say, hey, what's going on here? Unemployment's above 6.5%, and we're seeing medium-term outlook for inflation above 2.5%. That's very different from the charts I've just shown you. Maybe something's very different about the labor market. So I think what I like about our current guidance is it really allows you to be flexible in terms of the evolution of the data, and I think in a very appropriate way.
I've got a question here. If we're running a deficit of 10% of GDP, do you believe as an economist that if we were to balance the budget that our economy would grow at a -8?
That's an interesting question. I guess, I think that it would depend a lot on a lot of other assumptions, which we would have to lay out more clearly. I think that in the short, I'll answer your question maybe more generally than the way you phrased it. I think that in the deal that was reached in the New Year's timeframe to resolve the fiscal cliff issues, one of the things that Congress and the President decided to do was to not extend the payroll tax cuts. So payroll taxes went back up from 4% to 6%. And I think that does put downward pressure on the economy in the short term. It's not to say it was not the right decision. I'm not saying that at all. But it does put downward pressure on the economy in the short term. That I think there's a long-term tension in the U.S. fiscal situation. And you're going to be hearing a lot. I was glancing through the slides for the next speaker. You're going to be hearing a lot of very good information, I think, about the long-run tensions facing the U.S. economy, the U.S. fiscal situation. There's a question about whether or not you want to be resolving that over the longer run, because it's a long-run problem, or trying to get after it in the short run. Getting it after in the short run, given the situation we face in the economy, I think does expose the economy to short-run adverse demand pressures that are going to push downward on employment and push downward on prices. So from the point of view of a monetary policymaker trying to make a policy to hit the targets that have been set for us for Congress, trying to get after that long-run fiscal imbalances, disconnect between our long-term obligations to our older citizens and our long-term tax collections that are currently forecast, trying to get after that in 2013 and 2014 is going to make my job harder. That would be my view. There's a question up front.
Hypothetical. Your parents are retired. They're very conservative. They're scared of the market. Their plan was to have their money in CDs and live off of that. They're having a obviously very difficult time. What would you suggest they do?
I'm going to offer a jocular suggestion response first, and then talk more seriously about what the question I think is really about. So, as an economist, I gave my parents a lot of advice, and they never listened to anything I said. So, in a more serious vein, I think the question you're getting after is the fact that interest rates are very low right now. And when I've talked about how actually, despite the low interest rates we have right in place right now, we still, in some sense, do not have enough stimulus in terms of what's going on in terms of economic outcomes. I think that it is a very challenging time. If you're a person who's trying to roll over your portfolio, you're trying to buy CDs, thinking about you've got some money, where do you want to invest it? It's a challenging time right now. And part of that is from the fact that when the Fed lowers interest rates in order to stimulate the economy, I think it benefits us all, but it certainly benefits people who are trying to roll over their portfolio less than it does others in the economy. But I think that it's important not to think too much about the Fed in that equation. The big driver, and you can go out 20, 30 years in the yield curve, well beyond what the Fed is, I think, certainly my horizon for my involvement with the Fed. It's going to be what's going on there. You see downward pressures on real interest rates, U.S. real interest rates, all the way out there. Why is that? It's because of the fact that people are afraid. They're nervous. They're scared. They want safety when they go out and invest. But the supply of assets that people consider to be safe, that's shrunk a lot in the last 5 years. We used to all think about U.S. residential real estate being a safe investment. Sovereign debt, that was a safe investment. So all the supply of safety has shrunk and the demand for safety has gone up. So if you were in a position of somebody who, there's a basic rule of economics is if you're trying to do the same thing, buy the same good that everyone else is, the price you have to pay goes up, the return you're going to get goes down. And that, I think, is a huge fundamental force in what's going on in the economy that transcends what's happening with monetary policy. So even if we didn't, even if you go out, as I was indicating earlier, 10, 20 years, you see these downward pressures on the real interest rates going on. And I think that's a sign of exactly what I was describing earlier, the increase in demand for safety and the decline of supply of safety really handicaps people who are seeking safety.
Who owns the Federal Reserve, and what do the owners get or give up over the years?
Well, the owner of the Federal Reserve are the American people. That's who owns the Federal Reserve. And they own that, the ownership is in two very clear ways. One is that the representatives of the U.S. people have the option to change the laws governing the institution at any time. The Federal Reserve Act is our governing act. And changes were made in that. In 2010, through the Dodd-Frank Act, changes were made in the way we do things through that process. So that fundamental governance structure is Congress sets what we're supposed to do, and we do our best to achieve those goals. So that's one way. The other way is in a financial sense. I talked about how we made payments to Treasury. So when we have extra, we make money, as I just described, that money goes to the Treasury. That goes to the American taxpayer. So the American taxpayer is really the residual claimant on our operations. So in both the governance sense and the financial sense, I see the U.S. taxpayer, the U.S. people, as really being the owner of the Federal Reserve. And that's, of course, appropriate. That's who we're making policy for.
Going back to what you're talking about, the labor market, I'd be curious to hear about your assumptions as well as projections around underemployment and how that impacts your expectations around inflation as well as real GDP here as you project out for the next few years.
So this is a very challenging question. It's a question about underemployment. So I've been describing the path of unemployment. If you look at the fraction of people in the United States who have a job, so the fraction of people over the age of 16 who have a job, that fraction fell tremendously during the recession. So if we go back to my unemployment picture here, if I'd drawn a picture for an employment population, it would have fallen sharply, just as the unemployment rate's rising sharply. Employment population is falling sharply, not surprisingly, from about 63% to about 58.5%. But it has not shown the same kind of recovery. It's been pretty slow to come back up. So it's still under 59% right now, whereas it was around 63 in December of 2007. So some of this decline in the unemployment rate is coming from the fact that people are leaving the workforce. As well, if you were to look at the fraction of people aged 25 to 54 who have a full-time job, okay, so that's our prime age workforce. There's not really retirement issues and people quitting early or anything like that. That's our prime age workforce. Fraction of those people who have a job is, something like 9 to 10% lower than it was in December of 2007. So this is the underemployment issue that we're talking about. Some of that I think is due to the fact that I was talking earlier to the gentleman in the back about structural changes in the economy. I think some of that is going to be with us more persistently. Some of it, I think, and the good news is I think some of it will manifest itself in unemployment might take longer to come down because of the fact that people are going to be more, young people especially, saying to themselves, well, I'll look for work. So I think there's very tangled questions about what the long-run path of employment population looks like, long-run path of what full-time, part-time work compositions look like. I don't have really strong answers to that. I talk about unemployment because I see that as being the variable that is typically, when we talk about our employment mandate over the years, we've talked about it through unemployment. And that's the right metric for us to be using. But it is a complicated question. As those people come back into the workforce, though, what I think that means actually is that that means we're going to be able to, if more people are coming back in, that's going to keep pushing downward on wages. So that's the good news from the inflation standpoint. I see it end in front of me, so I guess that's it for me. Thank you very much. Appreciate it.